I'm very excited to do this panel. Again, my name is John Jacobs, and I'm the Executive Director here for the Center for Financial Markets and Policy. Did have a long history at NASDAQ, and I did a little bit of stuff in ETFs. I did notice, though, even though I work here, I'm the only picture not up there, so I definitely have to talk to the team and figure out why I'm left off, but I guess the important people are up there. Very excited to have this panel here because I think if by any measure, whether you're looking at number of listings, investing, trading volume, et cetera, you can't look at the way markets work today here and around the world without understanding how important exchange-traded products and exchange-traded funds are to investors and traders of all shape and size. And we have a great panel here to talk about it. Lots of different things to talk about. I'm going to just introduce them by name and firm, and then I'm going to give them a couple minutes to introduce a little bit more detail about their firm, and then we're going to jump right into it. And we will have time at the end for questions. We have a couple of mics lined up, and you guys can step up and we'll take the questions. So to my immediate left is John Zimmerman of Index IQ. Next is Reggie Brown of Cantor, Dave Laval of State Street Global Advisors, and Dan Draper of Invesco. So why don't we just start here. John, why don't you give us a quick little overview about yourself and Index IQ.
Absolutely. So thanks, everyone, for having us here today. John Zimmerman, I'm COO of Index IQ. We began as an innovative ETF provider, launched our first fund in 2009, really a leader in the liquid alternative space, acquired by New York Life Investments in 2015. Since then, we've really expanded our offering in ETFs and really integrated those with mutual funds to provide broad solutions to clients all over the U.S.
Great, thank you.
I'm Reggie Brown. I run the ETF business at Cantor Fitzgerald. Been in ETFs industry for a number of years, and I've helped launch a lot of ETFs over the last 20 years in various asset classes. I support the efforts of State Street, Invesco, and Index IQ as an authorized participant and as a primary dealer and also a secondary liquidity provider.
Great. So I'm Dave Lavelle. I'm representing the SPDR ETF business, which is State Street's ETF business. I run our capital markets team here in the U.S. Prior to that, was a colleague of John's at NASDAQ, and prior to that, ran a trading firm on the floor of the American Stock Exchange and New York Stock Exchange. The SPDR ETF business, about a $650 billion business that's part of State Street Global Advisors, which is over $2.5 trillion asset manager based in Boston.
I'm Dan Draper, Global Head of Invesco ETFs. I've been involved in ETFs since around 2005. A lot of the original experience was in Europe, and I came back to the U.S. to take over Invesco's ETF business in 2013. We are, as an ETF business, about $230 billion of assets under management with full range of, particularly we focus on more factor and smart beta. I think that's kind of the legacy of the old PowerShares business, but have number 4 globally, as well as a presence in Europe that's, I think, number 7 in AUM.
Great, thank you. Chair Clayton of the SEC was here this morning, and I would have, if my 2 questions were asked, that would have gotten, my first question would have been an update on the ETF, proposed ETF rules. And so I'd just like you guys to give some thoughts on, I think all of you, or close to all of you, submitted comments on that, et cetera. And so what are you hearing? What are your take? It seemed to me from my review that there was a lot more alignment around the commenters than disagreement. And I think people are looking for certainty. But anyway, I'd love to hear your guys, you guys collectively, your opinion.
So maybe I'll start and just frame it out that when you're an ETF issuer and you're bringing a product to market, it's a unique engagement with the SEC, and that you have to essentially engage with 2 different divisions. So the ETF rule is principally focused on concerns of the Division of Investment Management, and so that's your ability to actually bring a product to market or be an ETF issuer or take a product that investors that can then invest in. You also have the need to engage with the Division of Trading and Markets through an exchange, and that allows you to list and trade the product. And so what I would say about the ETF rule largely is, despite the fact that it's really a goal and an initiative of the Division of Investment Management, there are unique parts of it that have a feel of a trading and markets flavor to it. And so we've spent a lot of time very clearly in support of the ETF rule, because we would like to see more products come to market. However, ensuring that the entire liquidity ecosystem that really principally focuses on issues that are trading and markets issues are aware that there are components of the ETF rule that have that look and feel.
Dan?
Yeah, just, I mean, overall, we're big supporters of the rule. I think, the original Power Shares was, one of the early players, and we did benefit from early exemptive relief, giving us ability to do custom baskets and things that did give us a competitive advantage. So despite that, I think we really feel overall this rule just standardizing shows how mature and how mainstream ETFs really are today. And I guess for us, even though we lose just a little bit of competitive advantage, we think the standardization just more than outweighs any of the other details. And I think with Dave, I would agree. I think on just liquidity and things about a little bit around market structure, we agree there could be some tweaking. But overwhelmingly, we think the SEC's really got this one and done a good job.
Good. Reggie, how about your perspective from a market participant side?
Well, I think that it brings more participants into the marketplace and adds more liquidity with the transparency of custom baskets and the portfolios being released to all participants who care to read. I think one of the benefits of the rule, if it's passed as stated, will bring more scholarship into the marketplace because the data will be available, and I think we'll give better data to scholars to do research with better outcomes. A lot of times, the scholarship that's currently in the marketplace or is written in the past doesn't take in place impact or price discovery in some of the data that's presented. And then you get papers that miss the mark, in my opinion, around pricing ETFs and portfolios versus other vehicles. So by and large measure, I think there's positive measures here, and I think it flattens the playing field and brings more competition. It's a good thing.
Before I get to you, John, just let you know, Reggie's making sure to point out that the papers that missed the mark, none of them came from the McDonough School of Business at Georgetown University. So.
Zero came from
Yes. So anyway,
Georgetown.
so John, so from your perspective.
Yeah, I mean, I completely agree that standardization for the ETF rule is welcome, and I think everyone's going to benefit from that. The whole industry will, as will investors. One area where it's standardizing and just making ETFs more of a broadly accepted investment vehicle is kind of eliminating some of the somewhat arbitrary distinctions between passive and active. It's making it, passive should be if your stated objective is tracking a benchmark, your passive and active is some other performance outcome. Just like it is for mutual funds. And that's should be the way it is going forward. I think it'll just be easier adoption and understanding for investors as a whole.
So that's a good point, and Reggie touched on it a little bit. So the idea that you have to post the basket now, the transparency, how is that going to impact everyone, including ETF sponsors? About how does that impact indexers, and how does it impact the sponsors? Who wants to start?
Well, I'll start. There are some burdens. There's a burden shift on the sponsors around some data that has to be posted on websites. I think that increases cost for the sponsors, which invariably will increase prices. And then I also believe that in some of the thinly traded or difficult asset classes, particularly in some corporate bonds, the transparency is great, but I think it will also lead to some distortions in the marketplace, particularly around custom baskets, if the data is misused. So I think, like anything, empirical evidence is pretty important, and testing to see the effects in the marketplace versus all that's attended, and then having the ability to refine, a refinement period has been pretty important in my opinion.
So picking up where Chair Clayton and Stacy and Tom left off with leading with the investor, I think it's critically important that we all as an industry continue to lead with the investor's kind of voice and interest in mind. And again, to echo some of what Dan had said, we don't want there to be an operational arbitrage across different issuers, right? Because we would rather our products compete on performance and access to what investors want to invest in, as opposed to some sort of operational arbitrage that might arbitrarily exist because we came into the marketplace earlier than perhaps John's business did. But the goal is to ensure that investors are utilizing ETFs with a high degree of confidence. And we feel very strongly that the best way for investors to have a high degree of confidence is to ensure that market participants engage with the products with a high degree of confidence. And so if we can ensure that market participants are willing and able and interested in providing liquidity with a high degree of confidence in a robust way, the investor's experience will be better because spreads will be tighter, investors' costs will be cheaper, and everyone will win. And so that's the way that we like to think our philosophy is to kind of increase that investor's confidence, and which is in great alignment with the center's work here.
One thing I'll add, I think Reggie made a great point. He used the term data. And I think clearly, in a narrow sense, that could increase costs for sponsors and others who clearly aren't going to necessarily pass that on to clients. But I think this concept of data becomes just more and more important in terms of a revenue source, a cost, and looking at the whole ecosystem, issuers, market makers, exchanges, index providers. And I think, in the world of predictive analytics and big data is going to be so much more important. And getting your house in order, I think being able to do that. So this is just, I think, emphasizing one small area, but this concept of data is just going to, I think, really grow in the industry.
Yeah. I mean, agreed. Infrastructure requirements will go up a little bit. In terms of posting and disclosing data, I think that's fine. There's, just to get into some of the specifics around some of the bid-ask spread rules and specifics that were included in the proposed rule. Some of that is just, there's some technical aspects that don't really seem feasible, and so a lot of the comment letters that you saw had a very consistent theme about trying to standardize that or come with some sort of standard way of disclosing that actually includes the calculations and the intricacies of that.
Yeah, we want to make sure that the data we're providing to our investors is definitely being measured the same way and being delivered the same way, because we want to ensure that when an investor goes to one website at one issuer and to another website of another issuer, that they're actually receiving the same data. We also want to make sure that the data that they're asking us to deliver actually is useful, right? And so if they want to have bid-ask spread data delivered to clients, that's great, but let's make sure that we're actually delivering it in a way that is valuable to clients. One thing that we said is the SEC has done a great job of housing and warehousing data through their Midas platform. It seems like a really central place to have everybody gain data from the SEC as well, which we think makes a lot of sense and somewhat shares the burden while ensuring that there's consistency of the data.
Thank you guys. Have touched on some points I want to go into. This is a question you could probably go in a lot of different directions, which is kind of getting back to market structure. So, when I launched QQQ way back in 1999, it was on the American Stock Exchange, still independent. Tape B, there was a specialist system. There was a monopoly for trading on ETFs because they're the only market that listed ETFs at the time. Price per print was $18.61 a print. So there was a huge reward for the market participants who got the specialist to commit seed capital. Q started off its first day with a 3-basket commitment for just under $15 million with another $135 million commitment by the end of the week. Reg NMS, all the other things that have happened since then, we do not have a market structure like that anymore, right? So, and that market structure that for the secondary trading may work perfect for spiders and Qs and Microsoft and Intel and things like that, but I'm not sure it necessarily works for a thinly traded ETF, a thinly traded bank, or something else, right? So that's one question. The second question is, because there is less money to be made in trading, than there was with monopolies, et cetera, it is more challenging to get seed capital, especially when you fragment liquidity across multiple market participants. So lots of stuff in there. It's all about market structure, though, everything from the way we trade, the way we provide seed capital, et cetera. Reggie, we'll look at you first because you lived the battle, sure. Morning, noon, and night, et cetera. But I'd love everyone to weigh in on, does the current market structure for exchange-traded funds support new and or thinly traded ETFs? And is the same market structure that we need for, bigger, more established firms?
Well, I like to say that in this current market structure, investors of all stripes and retail customers particularly have benefited from competition and transparency and resiliency of marketplace where you're not reliant particularly on one venue or one exchange. So the outcome of investor experience has been measured as been terrific. And then from that phrase, I'll pivot by saying that the ability to raise capital and to launch new ideas and bring innovation to the marketplace, the barrier to do that has been lowered. and the opportunity to bring new ideas to the marketplace is unparalleled, easy to do, and that's a good thing for Americans. So in my view, you can categorize ETFs as equities, and what's good for Microsoft or Google may not be good for a new entrepreneur bringing an idea to the marketplace that has a market cap of 300 million. And so having a market structure that responds to issuer or sponsor needs is just a best thing to do. We haven't arrived at that with regulation NMS that was passed in 2005 and fully implemented in 2010. So I think if you look at new ETFs, how they're brought to the marketplace, who funds them, APs typically, or an investor, and then aggregating as much as liquidity as possible, bringing price transparency, and bringing all liquidity centralized. It is fragmented, but the transparency and resiliency outweighs that fragmentation, in my opinion. In having a restructured market class, it's a conversation that's being held today. Exchanges have various SRO and medallion rights to launch new exchanges. There's another conversation about the number of exchanges that's needed in the United States, and even another debate around market data and access to get that information. ETFs would be better served if there was multiple classes of market structure that allowed for aggregation of liquidity, particularly of thinly traded brand new ETFs. And as you had more support and more acknowledged in the marketplace, it perhaps graduate into a different type of market structure. But through competition, we haven't found that just yet. That was a long answer, sorry.
I'll just add just one thing on top of what Reggie said was, I mean, perhaps a bit more because of my experience in Europe for 14 years. We do support the concept of issuers paying market makers directly for seeding. I know some of us may disagree on the panel, but I just think in the reality of the world we're in now, we'll see I know there's proposed bank deregulation that's kind of pending, so we'll see, but we do think banks have been, particularly as market makers, but even other types of market making firms. And for us, we believe it's something that if it's a benefit to us and our clients, being fully transparent, having some goalposts around it, but in fact paying for a service that we definitely need and we think issuers need, would be in favor of doing that.
And for audience members who may not be or understand that, you can do it in Europe, but you cannot do it in the U.S.
Yeah, 5250. There are different kind of restrictions here in the U.S. But yeah, I think Europe is so fragmented. The plumbing, clearing, settlement is multiple different systems, and it's a very institutionalized market. MiFID II offers a little bit of promise to that, but in general, it's common practice. You're paying for the market-making services and the seeding in particular.
So I would say what's most important when we talk about these market structure issues is that ETFs in the U.S. markets represent, on average, somewhere in the neighborhood of 25 to 30 cents out of every dollar that's traded in the U.S. equity markets. I think on average this year it's closer to 22 cents, but in early February this past year and in some of the volatility over the past couple of weeks, that's gone up to 35 to 40 cents out of every dollar that's traded. So full stop. ETFs need to be part of the broader equity market structure conversation, and historically, even dating 3-4 years ago, we got a bit of the Heisman when you tried to kind of engage in the ETF conversation. How are some of these market structure changes going to impact the ETF market? You want to know what? They're in equity, it's fine. You want to know what? They're actually not always behaving like an equity, especially because of the transparency and the pricing that an ETF has. That transparency and pricing should be a benefit and should be something that we champion as an industry because it allows investors to kind of invest with confidence in a broad range of asset classes that they might not otherwise have access to with that level of transparency. I always use gold as the example. Before some of the gold ETFs were launched, your best chance to invest in gold was go to 47th Street in New York. You want to see a fragmented market? Go to 47th Street in New York, right? I mean, it's a difficult place to get a fair price. So I think we need to champion what the ETF has done for investors in the context of market structure because some of what is working really well, we should continue to be a tailwind to.
And one aspect, just with regards to the thinly traded products as the smallest issuer here, is you're launching new products and in a very competitive environment, one thing to keep in mind is building track records. And using the NAVs that are struck to build that track record over time, to let that build over time and let investors choose what types of exposures they want by the results of what's actually occurred in that underlying strategy.
So let's talk about price discovery of underlying versus the ETF, et cetera. And I think this is an area that's rich for research. There's, especially if more data is out there, et cetera. But I've heard this for the last couple of years, questions about, do ETFs have impact on the underlying constituents that are in there on price discovery, and what kind of impact do they have? I mean, I used to have arguments with Jim Cramer back in 99 and 2000 during the tech boom and then bust about, was QQQ driving the NASDAQ 100, or was it the other way around? And I certainly had my opinions on it. So just give me your thoughts on the impact, or what you surmise, and what we can do to figure that out.
So, John, you didn't convince him, obviously, because he still
No,
has.
I did not convince him, no.
But one of the biggest myths that we dispel all the time is that not every ETF trade results in a trade in the underlying securities. It's just that simple. So any measurement of data that we have does not support the notion that fundamentals of underlying constituents are being adversely or positively impacted by trading in ETFs. So there's kind of a ratio of the dollar volume that's being traded in the ETF securities here, and then the dollar volume that's trading in the creation redemption basket, so the underlying trading that's a result of this ETF trading. And so if I buy 100 shares of ABC ETF from Reggie, the reality is we're kind of engaging in that risk transfer in those ETF shares, and nothing's happening in the underlying exposure in the vast majority of the time, especially in the most actively traded ETFs that are being, having the finger pointed at them the most. It's just not the case that there's underlying trading as a result of it. So that's something that we talk about a lot with our investors and with regulators and with others.
Would you like to, what's the solution? How do we change that perception, or how do we get to the bottom of the issue once and for all for investors?
Well, I think that these issues are conflated oftentimes. And so you start off with the conversation of, I'm kind of going ahead on our agenda here, but you walk into an investor, and investor's like, I would never use an ETF for high yield. Okay, well, why not? Well, high yield ETFs are illiquid and high yield ETFs are volatile. And it's like, well, high yield is relatively volatile and high yield is relatively illiquid. So do you have a problem with your high yield exposure and your interest in investing in high yield, or do you have a problem with the ETF? And so it's separating the issues of like, okay, you have an investment need and an investment risk, and then you have to have a product need and a risk associated with that product, and then you have a liquidity need and a risk associated with how you're going to source that liquidity. So parsing those interests and those factors, I think, is a start, and then back to Reggie's point of making sure that academics have good data sets to substantiate their data, their research.
I think on Dave's point, I don't have the data for this current period of volatility we're in now, but I know back end of January, beginning of February, you did look at the big spike in the VIX and high volatility. Over 90% of the trading took place on exchange during that very volatile period. Very little led to creation redemption, and even in this current period, we've seen recently a record redemption in a very large, high yield ETF, and the credit markets didn't melt, right? I mean, it was handled even in the primary market. I think it was digested extremely well. Generally, credit spreads remain relatively tight to historical standards.
The other argument there, I think, the other argument to your original question was, is passive getting too big? Is passive in general? That's not an ETF-specific question, right? Passive is in mutual funds as well, and active is in ETFs. But I mean, I think that's the market will play itself out. If passive gets too big and there's an opportunity for active, active will start outperforming, and flows will shift the other way. But I think there's that underlying fear that passive is just going to take over and there's going to be no price discovery.
Yeah, and I mean, not that long ago, anything outside of a market capitalized kind of index, and nobody could speak better on this than John, were institutional strategies, right? These were really sophisticated strategies, taking factors and building weighting and in factor methodology into a passive instrument. But passive investment is mutual funds, it is ETFs, it's also institutional money as well. And so I recently was on a panel with a small cap active manager, and he went bananas on me about how passive management was getting too big and it's driving the market. And I was like, here's the deal. It's all transparent in ETFs. So if it's so transparent and it's driving the market, get in front of us and be smart. And you didn't really have anything to say, so I don't know. I guess it's not big enough.
Well, I think, Timmy, overall structure, forget about ETFs, but I think over the last 25 years, we now have, less than half of the publicly traded equities we had then.
Right.
So, and that's a
Right.
bigger issue that I know a
Right.
lot of the exchanges are leading, some great thought leadership there. But, there's been a big change, the rise of private equity,
Yep.
Sarbanes-Oxley. There's been a lot of regulations. Less companies are willing to take the plunge and become publicly traded.
Mm-hmm.
It's tough being a publicly traded company.
It is.
It's quarterly earnings, everything. It's a tough challenge. Let's talk about fixed income. So thoughts on where we are with fixed income. It's always the next big thing. It continues to grow, but I have my own thoughts on it. But I'd like to hear what you guys think about where we are and where we're going to go with fixed income ETFs and ETPs.
I'm personally short duration right now.
Short duration.
No. Well, I think fixed income, just a few numbers. I think last year, or I think currently fixed income is like 19% of total global AUM of ETFs, but 30% of the inflows last year went into fixed income. So it's a very strong secular trend. I think we have a lot of very talented people in the industry working on the plumbing, and again, this, if you will, an equity wrapper, but representing underlying fixed income markets. So I think more standardization. There's a lot of, and even I think about valuation. We value our fixed income ETFs at the midpoint, and many people are at the bid. So there's, I think, a lot of opportunity at even simple levels to make this a lot easier and more transparent for investors. So I think it's a very much, in terms of just secular growth, a very much a bull case. Fixed income is a lot of opportunity there.
Well, I think that I agree with Dan's statement. If you look at what ETFs have provided for the fixed income market structure, is price transparency, price discovery in an efficient manner, and the fixed income market structure is slowly to evolve here. So we're forcing innovation, forcing change. And if you look at, you mentioned high yield earlier, 85% of all ETF trading high yield ETFs is paired to one another and don't result in a creation or redemption of an actual ETF. And so you're bringing more investors to the marketplace with greater price transparency and price discovery. So if the fixed income industry does not want to involve or bring innovation quickly, passive and the ETF wrapper will do it for them. And so I think that's a great benefit. And it brings clarity to the investor. And also the pricing has been phenomenal. So if you look at the average spread, if you look at a high yield basket, to buy $100 million worth, you're looking at an impact of 75 basis points or inside that thereof to buy the basket itself of a typical high yield bond basket. But if you're looking at an ETF, you can do it within 20 bips. And so think about that from a pricing standpoint, where you're saving money by trading the ETF. This is not a recommendation. This is not about future performance. This is an observation from an ETF trader that...
But if you do, send the order to him.
You can definitely send the order to me. And you can trade one of the ETFs by these three fine gentlemen, to be neutral here. But I think if you look at it from a holistic perspective, you're opening up markets to investors that were traditionally hard to access or hard to trade. And so you look at the suite of ETFs on top of fixed income, whether it is government paper or corporate bond to high yield, yieldy, and then even really yieldy with riskier assets, you're just bringing the opportunity to investors to make a decision. And it's up to them to do the diligence.
Yeah, if we dig even deeper into that, I always talk about this cross-section of market structures that the ETF is causing. And so on the one hand, you have cash bond trading, which is historically hasn't really gone through the evolution or revolution that the equity trading has gone through. You still have voice brokered markets. It's still dealer driven. You don't have automatic execution. You don't have a centralized tape. You don't have the ability to have an actionable quote. You don't have an all-to-all market, right? Yet the equity markets, which are extremely automated, highly efficient, actionable quote, all-to-all, right? So when the market gets stressed, people always make this assumption that fixed income ETFs are going to blow up the market. In fact, it's quite the opposite. Fixed income ETFs are actually helping to rescue the market. right? So you add on top of that kind of disparity in market structure that I just described, impaired regulation to the bank broker-dealers post the financial crisis and limitation of balance sheet impairs their ability to actually deliver capital, infuse capital, bring liquidity to the cash bond market, especially in times of stress. So where's everyone going to go, right? So no one's picking the phone up when you want to trade a cash bond when things get stressed. So where are they going to go? They're going to put their quote into the ETF market. Everybody always assumes that everyone in this Armageddon scenario, well, what if it happens? Well, the reality is it has happened several times over the past couple of years, right? And it has been a great benefit to have the ETF. And so when the markets get stressed and liquidity dries up at the banks, the cash bonds can't be traded, and people run to the ETF market to either get out of their exposure or hedge the exposure they could otherwise not liquidate in the cash bond market, you see massive volume spike in those fixed income ETFs. And you say, well, where are the buyers? That's the whole point. Midday, when the markets are stressed in high yield and you're getting a midday return of, or yield of, 18, 19, 20%, there's a lot of people that think that's great. But they have no place to bid in the cash bond market. They do in the ETF market. And so to put really fine numbers on this, despite the fact that by assets, high yield ETFs are less than 4% of overall high yield exposure, on average, high yield volumes are over 10% of the overall high yield volumes. So high yield ETFs are about 12% of the overall high yield volumes. And when the markets get stressed, it spikes up even higher. And that's because there's certainty of execution. And I always say to an investor, if you want to sell your high yield ETF exposure, take a look at the bid. If 63 and 63.75 looks good, great, sold. You get your cash, you walk away, right? That's not to say you don't want to understand the underlying mechanics, but it's that simple, right? So underline the mechanics, learn the underlying mechanics, get comfortable with it, and then you have an equity experience.
So efficient markets, and you touched upon this when you talked about the market structure comparisons, one area you didn't touch, which is the underlyings themselves. So a share of Microsoft is a share of Microsoft, and options are no longer bespoke. For the most part, they're standardized options contracts, which really improve liquidity and transparency in the options markets. But the fixed income market is not that at all, right? So you can be a share of Microsoft, but Microsoft could have 20 different debt offerings with different covenants and different terms and different and expirations and interest rates, et cetera. And I think Wall Street, I think the banks have done a great job selling that to company treasurers and CFOs, saying we're getting you exactly what's perfect for your company and you're paying for this. But then they realize that they're doing that 20 different slices, as opposed to the more standardization of corporate debt offerings, for example, there might be more liquidity and more opportunity to trade and things like that and create baskets, et cetera, and so on. So that's an underlying. So in addition to the market structures you talked about, the standardization or the non-standardization of fixed income products with all the other variables in there with different expirations and terms and so on and so forth, is there any way that that's going to change?
You're heading down some academic theory. I just immediately think of like Merton and thinking about does capital structure matter? Then you get into agency issues. Well, CEOs are incentivized by equity. Did they want to keep the leverage fairly fragmented so they can add more to it to increase ROA? I don't know, kind of going down that type of path at a higher level. So I'm not sure that, again, depending on executive compensation for CEOs and C-suites, really promotes a lot of standardization. That's just a broad type of comment on that, not on market structure, obviously.
Well, I think you do have you have 35,000 different CUSIPs in fixed income,
Right.
With a $9.5 trillion market cap of the entire marketplace. And you have regulation that prevented banks from actually providing liquidity that actually added opportunity for firms like myself to step in and be that provider of liquidity in those marketplaces. Do I see big changes coming? I mean, this administration has been an advocate for less regulation and peeling back the burdens of regulatory for those banks. So I think things may change temporarily, until we see administration change. I think that you're not going to see changes of characteristics anytime soon. And you may see investor behavior shifts around market sentiment and the need for exposure. But I think that in aggregate, the complexity is contained, and still investors have gotten smarter through better education delivery by all market participants.
I mean, I just I don't think it's going to change anytime soon either. But just in context, I mean, any market, fixed income, corporate, relative to large cap U.S. equities and treasuries, is going to look relatively illiquid, right? And so an ETF, I think David mentioned earlier, is going to be as liquid as the underlying. And so in a time of stress where the underlying fixed income is going down because of liquidity issues or whatever the case is, the ETF is going to follow, right? And that's what it's designed to do.
So I'm going to have 3 more questions. I'm going to turn it over to you guys so you guys can start queuing up. So it's kind of different questions all over the map. So the first question is, let's talk about blockchain, distributed ledger technology, ICOs, et cetera. Any way you want to talk about it, because you could, and in full disclosure, I teach fintech and blockchain here at the university, and and Georgetown was just named one of the top 10 universities and colleges in blockchain and crypto. So we're very thinking very far ahead here. So I'm actually going to lay off my research on you guys right now. But anyway, just any way you want to look at it from the ETF perspective or the ETP marketplace, talk about what you see coming from in terms of blockchain, DLT, ICOs, anything. So,
Reggie, will there be a Bitcoin ETF? We've been asked 3 years in a row.
I've been broader than Bitcoin, so I went blockchain.
But I want him to get on record again.
On record again? Never. I will say a couple things. Once there is a strong regulatory framework in digital assets, which is not here yet in the United States, and won't be here because it's not the elements, right? There is an element of central clearing price. There is an element of regulation by venue. It's very difficult for the commission to wrap their hands around a positive approval because the data is not here yet. And the industry, I think, is forcing their hand by repeated attempts for relief and approval of products that cover that market structure, but market structure is not here. So no time soon. I'm pretty bullish on ICOs, but again, there's a lot of fraud, there's a lot of bad acting, and I think once you get the fraud out, I think it will solve the need to bring more investors in the marketplace by putting more capital formation in the hands of individual investors. So I think there is a long tail, bright skies once the regulation framework is figured out and the bad guys get out of the marketplace.
I'll take it a step higher in a different angle. So I said that the SPDR ETF business is part of SSGA, which is our asset manager, but we're an asset manager that lives inside of an extremely large custody bank. So we custody about $33 trillion of the world's assets, which is a lot of money. And despite the fact that it's a lot of money, it's not yet a very automated entity. And so it is technology innovation such as blockchain that can be, if utilized correctly, can really help automate some of those processes that are kind of end-to-end that right now are a bunch of individual processes. But the reality is that those technologies need to be quicker. It's not that they need to be more reliable, but they need to be quicker. And I don't actually think that there's enough intelligence and enough expertise that is necessary to kind of come into an organization that's as large and kind of has as much kind of critical financial infrastructure to wholly adopt yet. But there is certainly room within finance for technology innovation with blockchain.
I would just add, I think Reggie's points are right in terms of the blockchain or a Bitcoin ETF. I think in discussions with the SEC, 2 big issues, which he alluded to, is just that arbitrage pricing mechanism that's positive, them getting comfort with that, as well as a custody type of arrangement. So that's short term. For me, long term, I think the tokenization of assets has enormous potential. And I think the ability to, through some level of private market, but the distributed ledger, the transparency, and you think about all the issues we have with cybersecurity, centralized data, which is a growing risk every day, the ability to decentralize and in a transparent way have it on the ledger, that's massive. And I think particularly you look at less liquid assets. We were talking earlier about real estate, the world's largest asset class. Most of it is direct real estate, and you're somewhat challenged. But being able to do that in a tokenized form, huge implications on asset allocation and diversification. So it's big, and I think Reggie, you mentioned there are markets outside the U.S. which are making progress, and I think kind of watching as that evolves. But again, I think away from just pure cryptocurrency, I think the tokenization of assets is a really fascinating concept.
John.
Technology is fascinating. I mean, smart contracts as well. There could be broad application over time. At some point, that'll make its way into ETFs. In what form, I don't know. Fundamentally, I think there's just sort of an interesting concept of a Bitcoin ETF, because Bitcoin really emerged as decentralized, unregulated, anonymous, and then putting that into a centralized, regulated. It seems to be a bit of a disconnect, but maybe it'll happen at some point.
Can I make one comment from a different angle? I was recently at an IASCO meeting, which is essentially a group of regulatory bodies from emerging market countries and jurisdictions. And there was about 100 people in the room. And the first question that was asked is, how many people in the room have an ETF jurisdiction within their regulatory framework? And 5 hands went up. And so I was like, wow, we got some runway here, right? And the second thing that happened is, well, how many people in this room actually own an ETF for your personal account? I thought 100 hands would go up, and only 1 hand went up. And in the context of cryptocurrencies, which was another aspect of the conversation that was being brought to IASCO, was something that was really fascinating to me, is that the regulatory agencies and the jurisdictions that were being put together in this room to talk about advancements of ETF investment are looking to how they can get their investors, their populations within their jurisdictions, to be able to kind of get the money out of their mattresses and put it into a banking system that they can trust. And so it's about then taking that banking system that they can trust and finding ways that they can invest in a product. But when it was brought up about cryptocurrency, it's about moving money around the world. The immigrant that is having a wonderful experience making money in the U.S. needs to get that money back to a very small village, perhaps, in a third world country. And it's expensive to do that, and it's cumbersome to do that, and it's not reliable in many ways. Yet everybody in those jurisdictions that don't have ETFs have cell phones, right? And have great wireless capabilities. And so the ability for the hardworking immigrant in the U.S. to get that money back to the family in that third world country like that, that's what's going to drive some of what I believe blockchain technology is going to be utilized for.
Yeah, it's almost, obviously the World Wide Web internet was version 1.0, and it obviously has leveled the playing field, changed hierarchies around information, things like that, but it really didn't address money to a large degree, right? This is version 2.0,
Right.
And it's going to be blockchain driven
Yeah,
around money.
we've done a lot of work here on digital payments and financial inclusion. They're hand in hand. And the more you can bring people into the financial system here and abroad, the better it is. And a rising tide floats all boats there. And so we've done a lot of work on it. And the DLT and the blockchain has, along with mobile and internet, is a huge, a lot of factors coming together to really, I think, make massive changes worldwide, which will have impact. I'm just going to go to questions out for you guys, and then if there's a gap, I'll ask one of my own. So anybody out there have a question for our distinguished panel?
Can I ask one while they're
sure.
queuing up? We've enlightened them so much. Look at the lines.
Yes.
So as a graduate, I wanted to ask the question that was asked in previous panels to our panelists for the students that are in the crowd, how to think about one's career. And I think that we've all come from different angles, but you can start, John.
No, I'll start with you guys. I'll go ahead, Dan. Sorry.
Oh, gosh. Don't want to give away my age, but ETFs weren't around when I started my career. So I guess advice number one is to really think about skill set, developing your network, because you're probably likely going to be doing a job later that wasn't around, when you're kind of thinking about your career now, or if you're an MBA student, kind of redirecting. So I think developing, there's an interesting kind of book, and it's on TED Talks as well. Stanford engineering design professor. It's called Designing Your Life. I'm sure some of you probably know. I found that kind of interesting. I came across that about a year ago, and it's just taking, if you will, engineering concepts, design engineering, and applying it to your career management. And just one thing for me is prototyping. So rather than, I don't like what I'm doing today, let me do something completely different, how can you find ways to prototype? And a lot of it comes down to networking and trying small things, maybe volunteering, or my stage, I'm on some outside boards, so I use that as a way to learn and prototype. But how can you kind of build this engineering design structure around your life and career because we're going to have to reinvent continually.
So I walked into this place as a pre-med biology major and walked out as a pre-med philosophy and theology major, and not knowing what I wanted to do, right? So, and I had this view that there was this binary experience. Either I was going to kind of go into the Peace Corps and change the world, or I was going to go become this doctor that was going to make a lot of money, right? It was like this binary experience. And I think one of the things that I realized that there's actually something in the middle. And the other thing that I would say is that I think when I was here and I saw my friends that were in the McDonough School of Business and they were getting into the analyst program, and then if they got in the analyst program, they'd get into the analyst, or they would get in the internship program over the summer, and then into the analyst program, and then become an associate, and go get the MBA, and then come back as a VP, and then get into iBanking, and this like pre-prescribed path. There is no pre-prescribed path, is what I would like to say. And so they only call it your first job for one reason, because you're going to have a second job. So don't worry so much about your first job, is what I would say.
Interesting.
I've enlightened the man.
I'm still internalizing what he just said. You know, I was inspired by my grandmother to watch Wall Street Week on PBS. I'm showing my age probably.
Louis Rukeyser.
Louis Rukeyser when I was 11. And she gave me a subscription to Money Magazine when I was 12, and I was trying to buy stocks at 13. I got my first job during the summer at the Philadelphia Stock Exchange at 15 and a half, and went back every summer after that, and then went through college and never looked back. And I've been consistently employed in this industry because I found it as a fabric of a part of me, and I never really saw it as a job. And so if you have ambition, desire, the journey won't seem like a job. And I have two 19-year-olds in college. One's at USC, other one's at Hampton down in Virginia, not too far from here. And I tell them that view your life steps as a step into a journey that you don't know what's going to be the outcome. But if you view it from just a journey, it won't seem like a job. And so I hire young people all the time, and I talk to them quite a bit, and they have framework around, they have all the qualifications, but I look for ambition and desire to succeed, and for me, that's the designing moment. And so you're here at this fine institution, Georgetown, and I've spoken several times here, and I can tell you that designing one's career, you have to have a vision. And without that vision, and desire, the outcome may be somewhat missing the mark, in my opinion. And don't let anyone talk you down from that vision you have for yourself, because you never know where it may land you. So over the last 35 years in this industry, one way or another, from carrying lunches to doing what I do today, I find myself in interesting conversations, doing interesting work, and talking to institutions that are looking to learn. And I think one of the most touching, profound moments I've had was 2 years ago when I gave a speech to sitting governors of the BOJ in Japan on household inclusion in financial markets and bringing passive investments into lowering investment costs. Because in Japan, the average expense ratio is 3% for their investing cost to investors. And household engagement is not as robust in financial markets as it is here in the United States. And they were profoundly grateful of some of the sentiments that I brought to their country, and how I was treated was very touching, actually, where it brought a tear. And so you think about that journey from being an 11-year-old watching TV to do what I do today, that journey was uncharted, unexpected, and could not have been predicted.
Sage words, right?
I love that.
I would say just curiosity, right? You got to constantly assume that whoever you meet, whatever you do, you can't take what they do at face value in terms of their complexity. Whatever someone does is far more complex than you're giving it credit for. Whatever field you stumble upon has conferences such as this that people are getting together to talk about. Understand all those, figure them out. At some point in your career, I've been in a software company, wealth management, investment banking, now I'm here. It builds over time as you understand what's out there and you can actually get out there and do it.
So I would just add to all those, my youngest just graduated, so I have 3 who are graduated out in the workforce, and given them all the same advice. I said, you never know where your path is. There's no line. I don't know anyone who started, at 18 and knew what they wanted to do and ended up doing that at 58. It's just, I don't know those people. But you have to be open to the pivot, open to the change, and see where you want to go and follow your passions. Hard work trumps everything in life, and I never want to hear one of my kids say, or anyone I've ever mentored, anyone I'll talk to, that's not my job. Everything is your job. You will learn from every aspect of it, and that's the way it is. And none of us is as smart as all of us, and no man is an island. So, the people in an organization, when you look around, they want that team player, the hard worker, the one who's got the passion, energy, desire to learn, et cetera. And I'm an accidental indexer. I walked into indexing accidentally. It was just one of those things that happened, and nobody stopped me at NASDAQ when I was building that business. And I think there's a lot to be said for those kinds of things. So again, don't think you have to have all the answers at 18 and 22 and 26, because you're not going to have all those answers. And so that's the advice I'd give. And anyway, so questions? Yes, sir.
Thank you, John. Thank you, everyone, for the perspectives. My name is Omar Alamin. I'm an MBA candidate here at McDonough. I did research over the summer on payments market infrastructure and argued that with DLT, you need incentive plus $1 for the intermediaries to switch, for the market makers to switch. And I'm wondering if that story translates to the ETP market, where the only reason you would implement blockchain is if the money made there is $1 plus what you make today, whether you're an intermediary market maker, liquidity provider, what have you.
Well, I think the function of financial markets is risk transfer and price determination and transferring assets back to one another. And there has to be a financial incentive to apply capital and to have an outcome for risk assumption and mitigation. So with blockchain, where there's a ledger where you're just transferring one to another, there'll be changes to our financial system once the scholarship is fully developed and understood. And I don't think we're here yet. I think what you're going to see, particularly around payments, is a streamline and going to a cashless society, right? And then even in Philadelphia, I live outside of Philadelphia, I saw in a paper, Philadelphia is notorious for overregulation and ridiculous rules where, that's my opinion, I said that, that the city government is trying to outlaw cashless payments. But you have Uber that's cashless. So it's just not well thought through. So it's behavior change and an education long term. But in order to assume risk, there has to be a reward for that risk assumption.
So I'm going to answer it putting my old exchange hat on. The market makers that we face off with would love to control all of their destiny, but at the end of the day, it's a pretty simple business. It's the opportunity to be in the transactions market and to buy something more cheaply than you can sell it. And if you are on the floors of, I'm sure, the Philadelphia Stock Exchange when Reggie started, or the floor of the Amex when I started, you can find 2 traders that'll trade anything. How many chicken wings you can eat, or in an hour, or et cetera. So the point that I was going to make is that market makers and their ability to kind of engage and make money using new technologies is really going to be a function of somebody else making a decision to utilize that technology, is what I believe. So it will be the exchanges, or a change in an exchange model, or a change in regulatory framework that trickles down that will ultimately impact the market makers' businesses. But at the end of the day, the best market makers are the best problem solvers, and those that can solve the problem the quickest will seek that arbitrage opportunity and capitalize upon it.
Because I was going to say, I think just ultimately, Reggie was talking about like localities and taxation. For me, the blockchain, really, ultimately eliminates the arbitrage for money laundering. The ability, governments and municipalities can apply taxes on the ledger, it's clear what has happened on that side.
Yes, sir.
Kevin Toh from Data Body Technologies. My question is, like some compare ETF with target date fund, like in terms of resolving this like retirement issues with Americans. And what do you see exchange trade products would be like the next big thing to solve this Americans' retirement problems?
Price. I mean, the ETB marketplace has brought competition to all vehicle types and have lowered the prices and access to the marketplace. And I think one of the last barriers into the retirement community is how to solve who gets paid for what. And then looking at how retirement plans are administered, I mean, they're pretty expensive, largely. And you're talking about covering employees for a period of time. One of the issues with retirements is that the annuity tables are being blown out. You have a lot of 100-year-old retired teachers still living and collecting a pension where the annuity table said you're dead at 60. So I think that the ETP market is solving for lower costs, but the platforms haven't solved for who gets paid for what service.
If I could just maybe, that's kind of maybe at the wrapper area. If I think about the content area of the ETFs, this is where, you know, we and others are talking about kind of the factor revolution, which is happening, and that's the ability really in our digital world for every individual or every family to have a mass customized outcome, you know, because everyone's retirement needs and focuses are different. So I think really for us using, you know, the academic support of factors has been around really since Stephen Ross in the 70s in many ways, but being able to use this now popular wrapper with liquidity, price discovery, you know, where we've invested in, you know, value stocks and small cap stocks for 20 years, now thinking about does low volatility, momentum, and potentially even other factors in the future, does that really help someone risk return meet a very specific retirement goal, age, or, you know, so I think getting the almost the DNA or microprocessing chips within the retirement engine, and as Reggie said, the whole engine's got to get, you know, more cost effective, but I think that content is really evolving in a good way. Some of it won't make it, but I think through the market process, what does is going to be much more prescriptive for really outcome-based investing.
Yeah, and advice is changing, right? The advice market is changing as there's demographic shift as well, and the call from investors is transparency, and the call from investors is diversification, and the call from investors is having their hands on the reins of their investments, and ETFs are a wonderful tool for that.
Right. But it's imperative to educate on that and provide tools so that investors can get out there and put portfolios together to achieve their goals and meet their retirement needs.
I'll let you have the last question.
Sure. Steve Cohen, Velocity Lifter. David, you sucked me right in once you said traders should trade anything, and I really wasn't going to ask this question. But how are you guys, you know, collectively looking to sort of take advantage of tokenization? You know, when you said traders should trade anything, I think of, okay, people overseas that are going and buying, you know, special purpose vehicles, buying a basket of U.S. securities, tokenizing it, and then selling it off to, you know, any traders that wouldn't necessarily have access to the U.S. markets. How, as ETF providers, are you looking at maybe a model, something to that nature, which will help grow your business to people that wouldn't necessarily have access because they're not, you know, residents of the United States, or they don't, you know, I mean, the barriers of entry to trade U.S. securities when you're overseas, you know, for John or Jane Q. Public are pretty high. This I always found was kind of a pretty novel way of giving people that kind of access. Do you see, you know, playing around in that space at all, or could you give me some input on that collectively?
Yeah, I'll start as it was directed towards me first. We're not going to be the firm that does that because we're still seeing tremendous opportunity for the plain vanilla ETF to be invested in by investors around the world. We haven't even, you know, fully kind of cracked the nut of the institutional investor understanding precisely how to use a plain vanilla domestic equity-based ETF. And we have a lot of wood to chop there. So getting institutional adoption of the ETF is where we're going to focus a lot of our attention. You know, penetrating the fixed income market in the ETF wrapper is where we're going to focus our attention, and ensuring that there is kind of an international opportunity for an investor in Asia Pac to invest in a U.S. product, an investor in Latin America to invest in a European product, a European investor into the U.S. market, or whatever suits that investor's need. That's where we're going to spend our time ensuring that international use of this really innovative financial technology. That's where we're going to spend our.
If I could add, I think also Niall Ferguson, the kind of economic historian, he talks about in a recent book, hierarchy versus network. And I think clearly you're seeing the networks breaking down hierarchies, but there's some important hierarchies, legal and compliance, taxation, and I guess my 17 years living outside the U.S., I've seen examples where a Swiss individual got an inheritance. They've never been in the U.S. or been a U.S. citizen, but all of a sudden, because they're holding Coca-Cola or a U.S. domiciled stock, the U.S. IRS is going to ask for inheritance tax, or some way trying to get inheritance tax from them, not understanding the filing and all of that. And certainly being an American outside the U.S., there's frankly very little reason to hold securities outside of this home market because we're taxed globally. So I think once you there's still a lot of hierarchies and frictions, even though the technology will allow maybe tokens to move, but these kind of hierarchies on a regulatory basis or on a taxation basis, they're under the surface, and they're going to eventually become real at some point. So the whole ecosystem has to evolve on that, and it's going to take step by step.
All right, well, ladies and gentlemen, let's give our panel a great thank you.